Well, thank you very much for this opportunity to share some of my thoughts. This is a momentous time for Europe and for the world. It's a period of social and economic transformation. Progress that has been made in creating a market economy with a human face, a fair and equitable society. Rahm Emanuel, President Obama's chief of staff, famously said that we should not let a crisis go to waste. And the Great Depression led to a rash of social legislation that really transformed, for instance, the United States. What worries me is that the current crisis is being let to go to waste by those who are progressive and trying to transform our societies, but is not being let go to waste by those who would have us go back in time. In my remarks this evening, I'm going to focus on the economics and an economic growth agenda. I'm going to try to lay out the nature of the problems and why Europe's current strategy is almost surely doomed to fail. Markets on their own are not stable. Not only may they create destabilizing bubbles, as they have repeatedly done, most recently with the tech and housing bubbles, but once in a downturn, there are forces at play exacerbating the downturn. Unemployment and the fear of it spreading drives down wages, incomes, and consumption, and thus total demand, exacerbating the problem of unemployment. At the same time, this unemployment aggravates one of the main and persistent and underlying problems in advanced countries, and especially in the United States, the high level of persistent inequality and the lack of equality of opportunity. This is the theme of my recently published book that was referred to, which is coming out in Spanish in September, The Price of Inequality, How Today's Divided Society Endangers Our Future. Given these limitations of markets, government needs to play an active role, but the wrong policies can make matters worse. Governments with balanced budget frameworks have to cut back spending as tax revenues fall, an automatic destabilizer, a variant of which Europe seems mindlessly bent on adopting. No large economy, and Europe is a large economy, has ever emerged from a crisis through austerity. And this should not give you much hope. Austerity always, inevitably, and predictably makes matters worse. The only examples where fiscal stringency has been associated with recovery are small countries, typically with flexible exchange rates, and where trading partners are growing robustly, so exports can fill in the gap created by the cutbacks in government spending. But that is hardly the situation confronting Spain today. Its major trading partners are in recession and has no control over its exchange rate. European leaders have recognized that its problems will not be solved without growth, but they have failed to explain how growth can be achieved with austerity. So too, they assert that what is needed is a restoration of confidence. Austerity will not bring about either growth or confidence. The failed policies of the last 2 years on the part of Europe, as it has tried repeatedly patchwork solutions, misdiagnosing Europe's problems, have undermined confidence. Austerity has destroyed growth, it has also destroyed confidence, and will continue to do so, no matter how many speeches are given about the importance of confidence and growth. Europe's misdiagnosis of its problems has contributed to the wrong prescription. Germany has repeatedly said that overspending, fiscal profligacy, is the cause of the problem. But Spain and Ireland had surpluses before the crisis. They had low debt to GDP ratios. Hence, not only won't austerity solve this crisis, the straitjacket of the December agreement won't even prevent the next crisis. Structural reforms are important, but we should recognize that they take time and that they are supply-side measures. It is demand that is limiting production today. The wrong so-called supply-side measures, this wrong structural reforms, those that lead to lower incomes today, may exacerbate the lack of aggregate demand, deepening the downturn, and that's probably what's been happening with the labor reforms that have been instituted in Spain and elsewhere. What is the problem of the euro? The euro was a political project. It was brought about by well-intentioned politicians wanting to bring Europe closer together. But there was, at its founding, not sufficient political will to create an effective common currency. Europe is far from what economists call an optimal currency area, a group of countries that can easily share a common currency. Creating a common currency took away two of the key mechanisms for adjustment: exchange rates and interest rates. But Europe didn't put anything in their place. Europe's leaders knew this, but they hoped that in the ensuing years, the project would be completed. But as is so often the case, when matters are going well, there was no pressure. I had hoped that when things turned bad in January 2010, as Greece's problems came to the fore, that something would be done. But Europe temporized. Too little, too late. There were a number of other flaws in the economic framework of Europe. Free movement of goods without harmonization of tax and working conditions allowed for a race to the bottom in corporate income taxes and labor conditions. Free migration meant that children could escape the public debts of their parents by migrating, resulting in an inefficient allocation of labor. Some contrasts between the United States, where there is a common currency among the 50 states, and which works, and Europe may be illustrative. In the U.S., 2/3 of all public expenditures occur at the federal level. The federal government bears the brunt of welfare payments, unemployment insurance, capital investments such as roads and research and development. The locus of counter-cyclical policy lies with the federal government. The federal government backs the banks, even most of the state banks, through the Federal Deposit Insurance Corporation. There is free mobility of labor, but in the U.S., no one cares if some state like North Dakota becomes devoid of population as a result of outmigration. Indeed, it makes the cost of buying that state's congressman cheaper. That is markedly different from the case in Europe. Failure to address the underlying problems of the euro will be costly. The euro was founded on the principle that it would help create unity within Europe. In practice, its effect has been just the opposite. Old wounds and new enmities have developed. Stereotypes have been repeated. There is a way to square the circle to bring about growth even in the current circumstances.
Go on.
Some countries, like Germany, have fiscal room to maneuver. If they used it for investment, it would enhance long-term growth with positive spillovers to the rest of Europe, including Spain. A long-recognized principle is that a balanced expansion of taxes and spending stimulates the economy. And if the program is well designed, with taxes at the top, spending on education, the increase in GDP and national output and employment can be significant. This is called the balanced budget multiplier. Europe as a whole is not in bad fiscal position. Its debt-GDP ratio compares favorably with the United States. If each state in the U.S. were totally responsible for its own budget, including paying for all unemployment benefits, the U.S. too would be in fiscal crisis. The lesson is obvious. The whole is more than the sum of the parts. There are a variety of ways by which Europe could act together beyond the measures already taken. For instance, there are institutions within Europe, such as the European Investment Bank, that could help finance needed investments in the cash-starved economies. It should expand its lending. So too, funds available to support small and medium-sized enterprises should be enhanced. While large firms can turn to capital markets, credit contraction by banks hits small and medium-sized enterprises particularly hard, and in all economies, these firms are the source of job creations. Variants of these measures are already on the table, but they are unlikely to suffice. What is required is much more akin to a common treasury, of the kind that they have in the United States. A larger European Solidarity Fund for Stabilization, Eurobonds. There are a variety of institutional arrangements by which this common assistance could be provided. If Europe and the ECB were to borrow and relend the proceeds, the cost of servicing Europe's debt would decrease, and that would make room for the kinds of expenditures that would promote growth and employment. But the common austerity policies currently being discussed are little more than a suicide pact, an agreement to limit spending to revenues even in recession without a commitment from the countries that are in a strong position to help the weaker. The agreement of December was not a solution. The market has already rendered its judgment, and it didn't take long. But it was actually a step backwards. It represented bad economic policy. One of the victories of the Clinton administration was the defeat of a similar attempt by the Republicans to force a balanced budget amendment to the Constitution. We had not, of course, anticipated the fiscal profligacy of the Bush administration, the irresponsible deregulatory policies, the inadequate supervision that led to a ballooning of the federal debt. But even if we had, I believe we would have come to the same conclusion. It is wrong not to use tools in a country's toolkit. A primary obligation in modern economy is to maintain full employment, and monetary policy alone cannot do the job. Many in Germany say Europe is not a transfer union. There are many economic relationships that are not transfer unions. A free trade zone is an example. But the system of a single currency sought to go beyond that. Europe and Germany will have to face the reality. If they are not willing to change the economic framework beyond an agreement of fiscal stringency of the kind they agreed to in December, the euro will not work. It may survive for a little longer, causing untold pain in its dying throes, but it will not survive. The crisis exposed a number of other flaws in the European economic arrangements. A single market allowed under-regulated banks to operate in other jurisdictions, imposing enormous risk on the citizens of those countries. It is the responsibility of each government to protect its citizens, and if there is not an adequate European-wide regulatory framework, then the principle of a single market simply can't work. This is a problem which Europe is working on rectifying, but I am not convinced it has fully addressed it. But there is an even deeper problem that has been exposed in recent years. Confidence in a country's banking system depends ultimately on the ability and willingness of governments to protect depositors, typically through deposit insurance schemes, sometimes through implicit guarantees. At the same time, a country's banks are often a major source of funding for the sovereign. We saw in the crisis how quickly a problem in one could translate into a problem in the other. Bad banking debts in Ireland were nationalized. The collapse of financial institutions brought on recessions, and the economic downturn, in turn, led to large national debts. At the same time, with domestic banks holding so much sovereign debt, a decline in confidence in sovereign debt translates into a problem for the banking system. For the past year, Europe has been engaged in a fruitless bootstrap operation, Providing more money to banks to buy sovereigns helps support the sovereigns, and providing more money to the sovereigns helps support the banks. But it was nothing but voodoo economics, a very costly bootstrap operation, a hidden gift to the banks in the tens of billions of dollars, or euros, but one which the markets quickly saw through. Each measure was but a short-term palliative, the effects disappearing faster than even the pundits warned. The austerity measures have been particularly ineffective because the market understood that they would bring with them recessions, political turmoil, and disappointing improvements in the fiscal position as tax revenues declined or didn't grow as much as had been anticipated. Rating agencies downgraded countries undertaking austerity measures, and rightly so. With the inefficacy of the bootstrap operations and the austerity measures fully exposed, the financial system of the crisis countries has been put into jeopardy. This too should have been foreseen. With money flowing freely, why wouldn't a depositor put his money into a banking system backed by a richer country? The implicit or explicit guarantee gives the country's banks an unfair competitive advantage, no matter how hard Europe's leaders try to create a level playing field. But as money leaves the banks of the crisis countries, there is a downward vicious circle, amplifying and amplified by austerity. The weaker banks constrain credit availability, weakening the economy, weakening the government's fiscal position, weakening further confidence in the ability of the government to backstop the bank, and even more so if the worsening fiscal position is met with another dose of austerity. There is only one way out of this, a common banking framework, a European-wide backing of the financial system. Not surprisingly, the banks enjoying the implicit subsidies of the governments in a better financial position don't want this. They enjoy their competitive advantage, and bankers everywhere have undue sway over their governments. When there are imbalances, it is the surplus country as much as the deficit country that is to blame, and the burden of adjustment should be assigned to where the adjustment is easiest. This is the doctrine that the rest of the world has enunciated in discussions with China. China has responded with a remarkably large increase in its real exchange rate since 2005. The necessary adjustments, however, have not occurred within Europe, and particularly by Germany. Not every country can have a surplus, and so the view of some of those in Germany that others should imitate its policy is, in a fundamental sense, simply incoherent. For every surplus, there has to be a deficit, and particularly today, the surplus countries are imposing costs on others. The global problem today, as I said before, is a lack of global aggregate demand to which surpluses contribute. I talked earlier about the importance of those countries where the government can expand spending doing so. Similarly, these countries should engineer wage increases, particularly relevant in those countries in which workers' incomes today are little improved from what they were a decade ago. Making the euro work will not be easy, but the current course, focusing just on austerity and with mere lip service to growth, is a certain way to ensure that the euro will not work. Unemployment of 25% and with 1 out of 2 youth in Spain unemployed should be totally unacceptable. Spain, Greece, Portugal, Ireland, and others have engaged in austerity since the crisis began to little avail and with no hope in sight, no light at the end of the tunnel. There is no theory, no historical experience, no empirical evidence that suggests that there will be any reward to this seeming virtue. The consequences of Europe's rush to austerity will be long-lived and possibly severe. If the euro survives, it will only be at the expense of high unemployment and enormous suffering, especially in the crisis countries. And almost surely, the crisis itself will spread. Firewalls won't work if kerosene is simultaneously thrown on the fire. And that's what Europe seems committed to do. To repeat, there is no instance of a large economy getting better as a result of a dose of austerity. The consequences will be deep and long-lasting. Young people long deprived of a decent job become alienated. When they eventually get a job, it will be at a much lower wage. Normally, youth is a time when skills get built up. Now, it's a time when they atrophy. Society's most valuable asset, its human capital, is being wasted and even destroyed. There are so many natural disasters in this world: earthquakes, floods, typhoons, hurricanes, tsunamis. It's a shame to add to these a man-made disaster, but that's what Europe is doing. Indeed, the willful ignorance of the lessons of the past is criminal. The pain that Europe is enduring, especially its poor and its young, is so unnecessary. There is, I have suggested, an alternative course. But Spain cannot act alone. The policies that are required are European policies. Delay in grasping this alternative will be very costly. I have outlined a set of policies that could restore stability and growth. Unfortunately, right now, the kind of reform that would make the euro work is hardly being discussed. As I noted earlier, all that we have is platitudes about fiscal responsibility, about the need to restore growth and confidence. Quietly, academics and others are beginning to discuss a plan B. What happens if the lack of political will that was evidenced at the founding of the euro, a political will to create the institutional structures that would make a common currency work, what happens if this political will continues to be absent? As the widely used metaphor puts it, unscrambling a scrambled egg is costly, but so too is maintaining the current flawed institutional arrangements. Flawed currency arrangements have collapsed before. There is a price to be paid, but there is life after debt and devaluation. And that life can be far better than the depression confronting some of the countries in Europe today. I use the term depression advisedly. Spain's unemployment rate and growth deserves that dreaded D word. If there were light at the end of the tunnel, that would be one thing. But austerity provides no promise of a better world anytime in the foreseeable future. History and experience provides no basis for reassurance. I wish I could end on a more comforting note. Less than 40 years ago, you reestablished democracy. Democracy is more than periodic voting. In many countries, we've replaced a system of one person, one vote by a system that is more akin to $1, one vote. All over the world, we have to recognize that market economies have not been doing well. To mention the United States, for instance, the wages, the income of a full-time male worker today is comparable to what it was in 1968, more than 40 years ago. And for a full-time male worker who does not graduate, who does not go to college, the income, adjusted for inflation, is down by about 25%. So, since 1980 alone. So market economies have not been working for most citizens. These problems are not just the result of abstract market forces. Our politics shapes markets, and that's why in different countries the outcomes are markedly different. In recent years, some countries have actually managed to reduce inequality. Some countries have managed to maintain full employment. Some countries have been able to temper the excesses of the market. but many have not. The difference is a matter of politics. As we think about the situation in Spain and in much of the Western other governments and countries in recession, there's an important lesson to bear in mind. We have today the same human resources, the same physical resources, the same natural resources that we had in 2008. And there is no reason that we can't use those resources fully. And if we did that, our economy would be restored to its strength. We have huge unmet needs in our societies, and we have huge underutilized resources. This is a failure of markets. This is a failure of our governments to make markets work in the way they should. You have a huge challenge, a challenge to make our democracy work. Key in this will be civil society, movements like the union movement, in which there's been a concerted effort to weaken in this battle that has been going on since the beginning of the recession. It will be imperative that your voices be heard. I believe that we can change the direction that Europe has been taking. I believe that you have to change the direction for your sake and for the sake of the whole world. Thank you.